Let's get out to Peter Schiff, CEO of Euro Pacific Capital with AUM of over $2 billion. He joins us live from Western Connecticut. Peter, good to have you with us. Thank you so much for joining us today. Always controversial. I know you love it, so we're going to get straight to it. What are you talking about when it comes to QE4?
Well, you know, first of all, I was listening earlier. You had a guest on that said the Fed is dying to raise rates. And I think that's the last thing the Fed wants to do is raise rates. Of course, the second to last thing they want to do is admit that they can't raise rates. You know, if the Fed wanted to raise rates, they would have done it years ago. You know, and they keep talking about how they're waiting for improvements in the labor market, yet they pretend they're maybe going to raise rates in September. The labor market is not going to get any stronger between now and September. If anything, it might get weaker. I mean, we had a pretty bad private sector ADP payroll number today, just 185,000 jobs. The goods producing sector, the most important sector, particularly weak, just 2,000 manufacturing jobs created. And the labor force participation rate just hit a new low, so the lowest since 1976 or something like that, or 60, I forget. But it's the lowest of this cycle.
Wow. Okay. So you're saying the Fed doesn't want to raise rates. If that's the case, why do we have commentary like we saw from Dennis Lockhart in the Wall Street Journal, you know, just a couple of days ago, essentially saying, well, you know, getting more hawkish than ever?
Well, you know, they can't admit that they've inflated a gigantic bubble, and it needs a constant supply of air in the form of 0% interest rates, and I think more quantitative easing. They have to pretend that they've created a legitimate recovery that doesn't need this monetary support. You know, if they admitted that they're never going to raise rates, then the dollar would tank, and that would send short-term, long-term interest rates, you know, much higher. And the Fed doesn't want that. So in order to have their cake and eat it too, they keep talking about how they're getting ready to raise rates, but never actually raise them and have to deal with the consequences, which would be, you know, another financial crisis.
So where does QE4 come in then?
Well, because I think that just the absence of QE is enough to push the economy back into recession. In fact, if you look at growth in the second quarter, GDP, it's about half of what it was the second quarter last year. The economy is rapidly decelerating. In fact, growth for all of 2015 is probably going to be the weakest of the recovery. And so if the Fed couldn't raise rates last year when the economy was much stronger than it is this year, and by many measures the labor market was stronger last year because you had more participation than we do this year, and look at wages. In the second quarter, wages, nominal wages, this is even adjusted for inflation, grew by just 0.2%. That's the lowest increase since 1982 when they first began tracking this statistic. So the Fed is looking for wage growth. We don't have it.
Okay. Now, you've got to admit that you're a little bit outside of the square when it comes to some of the views that we talk about here on Street Signs. I mentioned in the intro, always controversial. We do love it, Peter, and we love to talk about it. But let me ask you, the majority in the market, if you look at the pricing right now, does expect the Fed to actually move in September. Now, if the Fed does move in September, but you are right, what do you invest in to protect yourself?
Yeah, well, remember, they used to think it was March, then June, now September, and pretty soon they'll be saying December. But, of course, too, if they do raise rates, and I'm not saying it's impossible that they're going to go to 0.25, right? They could do it just to put on a show. But there's a good chance that if they raise rates this year, the next move is going to be to bring them back down to zero. It's not going to be to raise them again. And, of course, you know, that risks a lot of credibility, which is why it is, you know, I think a bad decision for the Fed, given what they're trying to do to raise rates. Of course, they should have raised them a long time ago and allowed the economy to implode because it's a phony economy. It's a bubble. We need to let this bubble burst so we can build a real recovery, a real economy on savings and investment that creates a higher standard of living, good paying jobs, all the things that the Fed is preventing. But to answer your question, what do you do to protect yourself? Look, the dollar has had a huge rally. based on the anticipation of a normalization of interest rates, of a shrinking of the Fed's $4.5 billion balance sheet. All this is wrong. None of this is going to happen. It's all fantasy. That balance sheet is going to explode when they launch QE4. So the dollar is a bubble. You should sell dollars. Gold has been suppressed because people have been buying dollars and selling gold. Gold's a great buy. Gold stocks. And you've had a nice correction, I think, in your part of the world, in Hong Kong, some of these Chinese shares. I think there's a lot of opportunities there to look to protect yourself in the equity markets, because when the Fed unleashes QE4, that's going to send a lot of money into the emerging markets. A lot of money is going to leave the U.S. in search of safe havens.
Okay. All right, Peter. Look, it's always a pleasure, as I said. Thank you so much for joining us today. Have a great weekend. Well, we're going to take a break, but in fact, just before we do take a break, let's bring up the mystery.